All right. Today's Tuesday, the 25th of February. This is a recap for the macro events that we got in the last, week or so. It's really an economic discussion about stagflation. And folks, I got a good one for you tonight. But before we begin, I want you to check out this video that I opened for everybody, all viewers. And it reads, "Is Trump deliberately creating a recession?" Now, I think this video is the most important video that I produced year to date. And I would highly recommend that you visit that video and listen to the conversation that we had, because without understanding that conversation, you're going to be really confused about what's going on in the economy and the markets right now, what's about to happen to the economy and the markets. Most importantly, you're going to be confused about the discussion we're about to have in this video. Grab an adult beverage with you and maybe pop some Adderall before RFK Jr. takes them away. And let's dive in the main topic of tonight's discussion. And here it is, in focus tonight. Stagflation, baby. What are we talking about here when we talk about stagflation? Well, you might have noticed that last week something changed in the market. Something changed about the perspective on the economy. What changed? Because the Dow Jones went down 700 points on Friday. The market continues to go down throughout this week. So what's happening here? What's happening is, if you went back and you watched the video, the most important video of the year, you'll know that we talked about the Federal Reserve and the duality of the risk. And I've been floating this concept for a while now, the duality of the risk. That there is no such thing as soft landing. You have your inflation risk, you have your recession risk. The economy will tip over by one or the other. If you try to balance it and get a soft landing, you get a stagflation instead. And the fact that the Federal Reserve doesn't know that, the fact that the Federal Reserve has the God complex, where they think they can remedy inflation without the natural remedy of inflation. The most proven remedy is a recession. Recession is the natural remedy for any inflation. You need it. It's healthy. Every economy needs a recession once in a while for price stability and for affordability. But the God complex by the Fed, they think they can manipulate anything any way they want, and they can prevent a recession. They can reduce inflation without a recession. And now they're beginning to find out that that's not the case. But it is baffling that all of these PhDs and the Harvards and the Yales of the world, the Princetons, right, J. Powell, they don't know any of that. They think they can pull it off. They can do a soft landing. Meanwhile, a jerk-off financial YouTuber doing a show from his garage knows all of that stuff. I've been warning the Fed about that stuff. Maybe I should be the chairman of the Fed, which I wouldn't take the job anyways. Who the hell wants the job right now? And you'll understand why J. Powell is in a tough position right now, because the duality of the risk, inflation risk, recession risk. When we have the inflation risk dominating over the recession risk and increasing, becoming a threat, the Fed's focus becomes solely on the inflation risk, and they turn their backs to the recession risk. And in this case, of course, to remedy the inflation risk, they raise rates or they pause cutting rates, as we've seen recently. The Federal Reserve maybe made a mistake by cutting rates last year. And now they say, oh, wait a minute, the inflation risk came back and now it's more dominant than the recession risk. So we got to change the policy. And then, of course, if you have your recession risk taking over, then the Fed is going to look to the recession risk and focus on that and turn their back to the inflation risk. How do they remedy the recession risk? By easing, cutting rates, stimulating. But of course, when they turn their backs to the inflation risk to deal with the recession risk, what happens is, as they cut and stimulate to remedy the recession risk, they increase the inflation risk. And it becomes an inescapable game. And this is why we've been saying, folks, for so long in this channel, the natural remedy for inflation is a recession. Accept it. The sooner you get a recession, the faster we're going to get out of it, and the milder it's going to be. And everybody wins at the end. Sure, we're going to have job losses. We're going to lose jobs either way. Sure, the stock market will go down 50% from the top, but that's the price to pay. For the majority of the population, now we have affordable housing again. Now we have food pricing being affordable. Now we can buy assets, including the stock market, at a cheaper valuation. What's not to like? Recessions are healthy, but the Federal Reserve, by their God complex, they think that they can reduce inflation without causing a recession. And this is why we're in the mess that we're in. But let's assess the dual risk here. We begin with the inflation risk. Is that really going down? Because the latest data that we got, the household survey, consumer confidence was down, but consumer inflation expectations, the 5-year inflation outlook, has reached the highest reading since 1995. U.S. households now expect that the 5-year inflation outlook will be at 3.5%, if not above. That is way above the Federal Reserve 2% bullshit target. We got more alarming data regarding inflation. Last week, we got the Empire State Manufacturing Survey and the Philly Fed Manufacturing Survey, and both of them pointing out that prices paid are moving higher. That, of course, tracks the CPI and PPI, so this is not looking good. It doesn't look like the inflation risk is going down. Furthermore, we got the PMIs, and the phenomenon that we notice in the economy right now, the services sector of the economy, which is the most efficient and disinflationary, is slowing down. That's a major warning sign. That's a recessionary warning sign. But all of a sudden, we see the manufacturing sector of the economy beginning to heat up again. And not heating up from, let's say, activities, but heating up from prices paid and prices charged, as you can see from the chart that you're looking at right now. And if that is the case, that's inflationary. Why do we see manufacturing becoming inflationary again? It's because of the tariffs, because of the uncertainty from the policies out of the White House. You look at the 2-year TIPS break-evens, now above 3%, so it aligns with the household surveys of inflation expectations. Every metric right now points that inflation will be above 3%, and it's going to begin to diverge from the Fed's target of 2%. And of course, now the question becomes, you're looking at the CPI. We've seen a bottom at around, let's say, the third quarter of 24, and we've seen a recession scare in the summer of 24. So the Federal Reserve said, you know what, inflation is about 2.5%, and we have recession risk showing up, so let's cut rates. Let's do the jumbo rate cut in September, which is one of the biggest mistakes the Federal Reserve has ever committed. This is the problem, by the way, of the fantasy of data dependency, because the data is bullshit. The data is all cooked. And that was a false alarm, the recession data that we got in the summer last year. And the Fed reacted based upon that data. And as they did that, we've seen inflation bottoming, and now the inflation risk beginning to increase. And all of a sudden, we're now at 3% CPI. Next thing you know, 3.5%. And are we going to begin to look as the inflation episode that we got in the 1970s, where inflation bottomed at about 5%, market went down a little bit, the Fed jumped the gun again by easing, and what happened? Inflation came back with more aggression. And ladies and gentlemen, even The Economist, which is a huge propaganda publication, says that investors fear inflation is coming back. They may be right. Is the world about to repeat the mistakes of the 1970s? It sure looks like we're on track. This is, by the way, the same economist that said in the summer of last year, inflation is down and a recession is unlikely. What went right? A few years ago, nobody thought that a soft landing was possible. They also said why inflation fell without a recession. This is what happens when you're a propaganda publication. This is, of course, a propaganda wing of British lack of intelligence, otherwise known as the MI6. And they're political hacks, and they change the headlines based on whose administration is in the U.S. and that kind of thing. So they had all these favorable headlines last year. Now they're changing the headlines and accepting their reality. A lot of folks, of course, brought up the risk of the Japanese yen carry trade. That maybe that was the reason the stock market went down last week. I disagree. I don't think we have the risk of the Japanese yen carry trade, at least not close enough. Maybe if the yen continues to rally, we're going to get to that point again. The problem from Japan, though, is what we talked about numerous times in this channel last year, which is at some point we're going to see the war between central banks. It seems that they're all in alignment right now, or they're cutting rates together. But at some point, you're going to see divergences. You can see BOJ, for example, as the Fed cuts rates, devalues the dollar, commodities go higher. As commodities go higher, it increases the inflation risk in Japan. Well, the BOJ has to do something. They have to hike rates and firm up the yen to tackle the inflation rate. And as they do that, it adds more pressure on the dollar. The dollar keeps going down. And as the dollar keeps going down, commodities prices keep going higher. We could see the same thing in the ECB, by the way. At some point, we might see inflation rising higher in Europe, and the ECB says, no more. We're not going to cut rates anymore. We want to firm up the euro and maybe begin to raise rates again. That's going to demolish the dollar even more. So when we see headlines from Japan that the inflation rate is a 2-year high, 4% in the month of January, and now the BOJ is expected to hike rates, sure, it adds more pressure. As you can see in the chart right here, Japan is leading inflation now, which means that they have to act faster than us and the European zone. And if they do, they're going to devalue the dollar and firm up the yen. That's inflationary. Dollar goes down, commodities go higher. So again, in conclusion here, folks, is the inflation risk eliminated? Is it going down? Absolutely not. It is sticky and it keeps going higher. Let's discuss now the other risk, the recession risk. Is that going down? Is it going higher? Because the entire freak out that we have in the market right now is because of the recession risk. And gee, what triggered all of that? We got headlines like this. Walmart's supposed to be one of the strongest companies in the economy. Even Walmart now saying that we're going to slash the sales growth forecast. They say that the consumer is getting weaker. They're afraid about the tariffs and how costs will go higher and margins will go down. We continue to see businesses going into bankruptcies. The number of bankruptcies is surging higher. The latest being Hooters, filing for Chapter 11. It's an end of an era, folks. For all of you creepy diners, you gotta stick to Denny's now. But even Denny's, by the way, can go bankrupt soon. But it wasn't just Walmart and Hooters. We got more recession warnings last week. For example, U.S. job construction openings are collapsing, dropping like a rock. We have seen a decline by over 250,000 jobs.
Oh my God!
That is the lowest reading in 8 years. And again, they say that such a drop has never been seen outside of a recession. The reality, folks, and some of you who are smart at least, you know that the economy has been in a recession since 22. The economy was supposed to dip into a deeper recession, and the market was supposed to crash when the regional banks began to crash in the first quarter of 2023. But because the Fed intervened and began easing and bailing out, combined with the AI mania by the big cap companies who still had a lot of hordes of cash, what we've seen is what was in a recession, was weaker, remains weak, and keeps getting weaker. But then we see a certain segment of the consumer and the economy, the B2B spending, the affluent consumer, thriving and spending more. And the result of this gap of the lower income consumer being in a recession, a lot of businesses being in a recession, but other businesses that cater to the affluent consumer, the stock market, the B2B spending, that's doing pretty good. This gap is causing a lot of stagflation, and we'll talk about that in a minute. But let's cover the recession warnings before we talk about stagflation. We all hear what's going on with the federal government and the mass layoffs. Now, nobody talks about this issue more than I do, that we need taxpayers' accountability. If we pay taxes, we will make sure that you're using the money efficiently. Not for stuff that goes to our benefit. Not the wars, not the bullshit spending and the waste. But the question now becomes, are they really doing a good job when it comes to the layoffs and the cutting? Well, let's read some of these headlines. The Pentagon, which is the biggest laundromat in the world, huge money laundering operation in the hundreds of billions of dollars. You got to remember that the Pentagon failed the audit years in a row. Every year, the Pentagon fails in auditing. Why? Because they're washing tons of money. Hundreds of billions of dollars go missing from the defense budget, but we can't question that because they'll call you unpatriotic. What do you have against defending the country, brah? I don't have nothing against defending the country. I have something against the corruption. I think wasting taxpayer money is unpatriotic. But anyhow, now we have even the Pentagon is readying to fire thousands of civilian employees. So you don't see just the layoffs in the private sector in Meta and Starbucks, in Amazon. You see it now even in the federal government and the Pentagon. We're talking about thousands of workers. Thousands of workers got the boot in the IRS, the fascists. I'm not talking about the employees. I'm talking about the IRS. But there's a huge question here about Doge, which is, by the way, led by your Lord and Savior, the Rev. Elon Musk. In principle, we support Doge because we've been waiting for accountability in spending taxpayers' money. But what's causing the problem right now is the market and watchers are beginning to question whether Doge is actually doing a good job or not. Their job is to cut the excess and reduce the budget deficit, reduce the growth of the national debt. But it seems that Doge is becoming more political. They're cutting stuff they don't agree with politically, rather than pursuing the efficiency mandate. So you see a headline like this: Doge savings estimates fall by $9 billion in 48 hours. What the hell is going on here? The market is worried that we have Doge firing all of these thousands of employees, increasing the recession risk for no good reason, for no improvement in efficiency. Here's another headline for you. Nearly 40% of contracts canceled by Musk's Doge are expected to produce no savings. 40%, no savings. And now we're beginning to see chaos within Doge. 21 employees resigned from Doge, refusing to dismantle critical public services. So now we have a spat. The employees are beginning to question, well, wait a minute here. Are we really doing efficiency, or are we just targeting stuff for political reasons? What's going on here? And the market is also beginning to question the efficiency endeavor by Doge. Efficiency, good, because it increases productivity, it increases the fiscal outlook. But if you're just firing thousands of employees, for the sake of it, you're increasing the recession odds in the economy. More recession news for you. We got the Citi U.S. Surprise Index, the lowest since last September. So we're seeing worse and worse economic numbers. And when you see a downtrend like this, it usually happens by preceding a recession. On Friday, he tweeted this: FedEx was crashing by almost 10%. And the transportation stocks, the trucking stocks, were also crashing 8, 9, 10% apiece. Now, if you know anything, the Dow theory, the transportation stocks, including FedEx, including the trucking, if they begin to go down, that's a leading indicator that the economy is about to dip into a recession. And by the way, just to brag a little bit here, in my morning brief on Valentine's Day, suggested that you go with a bearish trade against FedEx. Gave you this chart right here. We're going to see an inverse ABC. Didn't work out for a couple of days, but then boom, it did. And if we see FedEx heading down from this point on and breaking support, then it's going to solidify that it wasn't just a one-time scare. You got to remember that the market leads everything, and the market's going to sniff the recession odds and act properly. It begins with dumping home builders. The home builder stocks already topped. They're in a bear market, quote unquote, because they're down 20% apiece, topped where they're trading right now. If we see the same thing in the Dow Transportation and the FedEx and UPS of the world, I mean, UPS is already in a bear market. If we continue to see that, that's going to be a leading indicator that watch out here. Yeah, the recession odds are for real. And again, the PMI was really important on Friday. It added to the problems and the sentiment crush that we got. Why? Because the hottest sector of the economy, what got us out of the recession odds, we're placing all of our bets on it, the services activities in the economy, they dipped down negative in a sharp drop. While we see manufacturing beginning to recover, but manufacturing is way smaller than services in the economy, number one, so it cannot offset any drop in services. Number two, we see heating up in manufacturing activities because of inflationary reasons. They want to get ahead of the game before the tariffs hit. And that's increasing price expectations, by the way. But the fact that we have services going down, folks, into negative growth now, that's a huge recession warning. Furthermore, we got the data today that U.S. auto loans with serious delinquencies, 90 days plus, hit a rate of 3% in Q4 2024. This is the highest rate in 14 years. This rate of serious delinquencies has now surpassed the 2001 recession and the 2020 pandemic recession. Folks, I can show you more and more data. You get the picture right now. We just concluded here that the inflation risk is sticky and going higher. It ain't going down. We just concluded from the data that the recession risk is increasing too. So you don't have a give up where we see recession risk down, inflation risk higher, or inflation risk going down, recession risk going higher. If you have a trade-off, okay, the Fed can manage things and kick the can down the road and play the soft landing bullshit. But it appears right now, with the duality of the risk going higher, all together, the inflation and the recession risk, what do we have here? We have, if you said stagflation, you got it. When it comes to stagflation, it's the nightmare scenario for the Fed because they can't do anything. They're handicapped now. If they increase rates to tackle the inflation risk, they're going to increase the recession risk and the crashes in the economy. If they begin to ease the policy to mitigate the recession risk, they're going to increase the inflation risk. Now it's game over. The media, the street, the investing firms are now beginning to catch up to what we've been talking about in this channel for over a year now. That we're not going to see a soft landing. Instead, we'll see stagflation, then a deep recession after that. The headline from Reuters reads, U.S. business activity is stalling. Recessionary? Yes. But consumer inflation expectations surging. Inflationary? Yes. Combination of both? Stagflation. While we all feel worried about the economy, folks, with this stagflation problem, rest assured the CEOs and the banksters, they say that they're full of optimism because they're living in a different world. They're living in the Hamptons and the bubbles, and they have no intelligence at all to relate to the main street. Not to mention, of course, they're robbing us by increasing prices and doing gouging and all of that. Of course, they feel good and full of optimism. But folks, this stagflation risk is going to break even the sentiment by the CEOs and the companies. Bloomberg now says stagflation is poised for a comeback. Market Watch says Dow wipes out its gains since the Trump inauguration as stagflation fears return. The S word is all over the place all of a sudden. Even the Fed now says stagflation cannot be ruled out for the U.S. economy, according to the St. Louis Fed. Now, here's the important thing that we need to talk about. Now that we've concluded that we have stagflation, what's causing this economy to hold right now? What's causing inflation to hold right now? The main reason. The main reason is we have a broken economy, and the majority of the consumption is led by the affluent consumer. The economy is great for the CEOs, for the banksters, for the trust fund babies, for the whores and OnlyFans. It ain't good for the regular folks. You see the gap in excess savings between the top 10% of earners and then the other 90. The other 90 is getting creamed. The top 10 are holding still. And when you look at the spending by income group in the economy, the top 10% of earners now account for half of all spending. We've never seen that before. It's the Gilded Age. It's the oligarchy. In other words, to tackle inflation, you need to induce recession on the top 10% of earners, because the lowest 20% of earners already in a recession. The 20 to 40 already in a recession. They can't spend anymore. You got to hit the top. How do you hit the top? By crushing the wealth effect in the economy. That's only going to happen, folks, if there is a stock market crash. And this is why a lot of folks are bringing the comparison. 2008, 2025 in the Dow Jones. 1929, 2025 in the Dow Jones, or S&P, whatever you want to use. Could it be this big, really? Could it be a crisis kind of crash? Yes, because the higher things go, the more debt is accumulated in the economy. The more you kick the can down the road, the harsher the recession and the bigger the crash. And this is why perhaps we see the greatest investor of all time, Warren Buffett, warning. He's not saying, hey, folks, we have recession coming, or we have a stock market crash coming. He's not saying any of that, because last time he did, they blamed everything on Buffett. He scared everybody, yada, yada, yada. So he doesn't do that anymore. But actions speak louder than words. Of course, the perma-pumpers would say, oh, but Buffett is about to die, so he's just doing some estate planning. Because perma-pumping is a disease. It makes you not able to think. Warren Buffett is dumping stocks like we've never seen before. 9 consecutive quarters of dumping stocks. Berkshire Hathaway is now hoarding more cash than ever before. Why? Because Buffett is waiting for the crash and he wants to scoop all of these assets for pennies on the dollar. That's why he's the greatest investor of all time. The CEOs and the banksters, you look at Jamie Dimon, he sold 33% of his JP Morgan stock on February 20th. The co-CEO dumped 20%. This is huge. We've never seen Jamie Dimon dumping this much out of his JP Morgan stock. But who's being cocky? Who's being stupid and arrogant? It's the young traders, the retail traders, the mom and pops, the retirees. The headline reads, young traders don't care if stocks and cryptos are in a bubble. They could get a rude awakening. I mean, when you talk about cryptos, that's the biggest scam in history. We gotta look back at it as what the hell were we thinking? Fake assets that produce nothing at all? We valued that at trillions of dollars? What the fuck was going on back then? Listen to this headline right here. Hackers steal $1.5 billion. The biggest crypto heist ever. And guess who's behind the heist? It's Kim Jong-un from North Korea. And I warned you about this. Wait till Kim Jong-un steals all of your cryptos. Wait till Kim Jong-un cleans your crypto account altogether. But again, nothing is going to deter the retail investors' arrogance. Nothing will do that, especially the newcomers to the market. We see that every time. We've seen it before 2008. We've seen it before the dot-com crash. We see it every time the market goes down big. Before that, we see excessive bullish sentiment, specifically by the retail traders. Active traders now, 49%, they say that they're bullish, moderately bullish. When you add to that the very bullish, the majority of investors and traders right now say, we're bullish. There's no risk here at all. And why is Warren Buffett dumping? Why is Jamie Dimon dumping? And the other side of arrogance and complacency comes from folks who are about to retire. Headline reads, your retirement savings are at risk in a clearly insane stock market. The fund managers admit they're buying overvalued stocks. But when you speak to the seniors and the folks about to retire, they're more arrogant than ever before. Oh, but my 401k is in the moon, bruh. I'm already planning all of the vacations and the cruises and the stuff that I'm going to buy. You don't understand. This is a new era. The Fed got it. AI got it. I've never seen such arrogance and complacency by folks who are about to get royally fucked when this whole thing plays out. Because you'll never see these pricing again in your lifetime. You'll be a corpse, a mummy, before you see these pricing again. What are you going to do in retirement if the market crashes by 50% and you bought at these excessive valuations? What are you going to do? Now, folks, since we have the stagflation risk, this is the newest threat to the stock market because everybody was pricing in a soft landing. Now we have to price in stagflation. What investors should know. I tell you what you should know, what you should do. Do yourself a favor. Use the link that I got in the description for you and become a Maverick member on Patreon for 50% off. This offer is going to expire on Friday. It's never coming back. And after that, we're going to jack up the rates. But with that, folks, this is all I got for you for this coverage. Thank you for joining us tonight. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
We've all been raised on television to believe that one day we'd all be millionaires and movie gods and rock stars. But we won't. We're slowly learning that fact. And we're very, very pissed off.